In this video, I'm going to give you the complete guide to the double top and the double bottom chart pattern. I'm going to show you what they look like, how to spot them, and more importantly, what do they actually mean? Are they telling us we're going to get a trend reversal, or are they a sucker play designed to get your money while the trend continues onwards? My name is Mark from TradeInform.com, and I have been analysing and backtesting the financial markets for years. In this video, I am looking at these classic chart patterns, the double top and the double bottom, and answering the question that you need to know is, are these patterns relevant for the modern trader? And I'm not just crunching the numbers, I want to understand what they mean. Now, I'm doing my analysis today on 6 of the most popularly traded ETFs in the world, the SPYs, the Qs, IWM, 6 key ETFs. And it is very crucial to understand this, that the market you are testing and trading makes a big difference. These patterns do not apply universally to every single situation. Now stay tuned and I will explain more. Let's start with the double bottom. First of all, you want to see something that looks a bit like this. You want to see the lows somewhere about the same price. They're not going to be exactly the same price, but pretty close. We're going to see a downtrend preceding it. We're going to see some sort of a recovery in the middle. And then we want to see is a full reversal of the previous trend in the next move. Now for the double top. We want to see a mirror image of the double bottom. So we're looking at the high prices. We want to see similar level high prices. We want to see a preceding upward trend. We want to see a small attempted recovery. And then we want to see the price direction change. On the screen, you can see the TradeInform backtest model that I've used in all the analysis in this video. As you can see, this is in Excel. You can use it to develop, to optimize, and to backtest your trading strategies and to get more winning trades. Now I'm going to explain exactly how I've used it in this analysis. You can see here the example of the Qs here. I've not used a profit target or a stop loss. But when you come to understand each of these patterns in more depth, you can very easily do that and you can see the results adjust in real time. Now, the only thing that I have used in this analysis is I've used a time close, and that has been consistent over every scenario. I'm closing after 20 bars. Now, to get into the detail, because the devil is in the detail, what one person sees on a chart pattern is what is different to what another person sees. Now, the preceding trend, this is identified by a series of highs for a double top and lows for a double bottom. This identifies the preceding trend. Now the maximum deviation, this is how horizontal the double bottom or the double top is. There's always going to be a small amount of deviation. However, to get the classic pattern, we want this to be as low as possible, but we need to understand how where the variability is. Now, the way I have compared these two crucial variables is in an optimizer matrix. You can see here I've measured the preceding trend against the maximum deviation, and this makes a big difference in the results. If you're the sort of person who wants to understand more about the analysis I am doing in this video, about technical indicators, about chart patterns, on the screen you can see my 21 more indicators spreadsheet, which has the double top, double bottom, and a whole host of other technical indicator formulas, all easy to use with explanations and in Excel. You can get it in my Teespring store underneath this video on YouTube, at TradeInform.com, and in Amazon in the Amazon Kindle store. As I said earlier, I have crunched the numbers so you don't have to. In my optimizer matrix, I have compared the strength of the preceding trend against the horizontal variability. I have also tested long only compared with long short for both the double top and the double bottom for each of the 6 markets. And finally, I've compared each market in their traditional form as a trend reversal pattern with trading the exact opposite. So treating each pattern as a trend continuation, going long on a double top and going short on a double bottom. Let's have a look at the detail of my results. First and foremost, my biggest finding was that the The inverse pattern, in other words, treating the double top as a long entry signal and the double bottom as a short entry signal, outperformed in each market. It outperformed the standard interpretation, outperformed considering them as a reversal trade. And that was consistent across all of these markets. Secondly, long only, which you can see here in the tables on the left, and long short performed similarly in all scenarios. And considering the upward drift of all of these markets over the past 20-something years included in the analysis, is a decent result for short trade. So I would take that as a good sign. Finally, there is quite a lot of variation between each of these markets. So you see SPY here, you can see the heat map centered around 0.3% horizontal variability and around about 30 days of trend significance. But that's quite different to the Qs, to XLK, IWM, and GLD going down here. So each of these markets together, we don't have a huge amount of significance. Taken together, you would have to take a lot of these trades to start to get the significance and start to get the reliability of this trade entry system. Double tops and double bottoms are classic chart patterns. They are part of this compendium of price action analysis that has been passed down from generation to generation, from trader to trader for years and years. And every trader should be able to spot these patterns, should be able to see them in the chart, see when they've happened and see when they may happen. They're based on sound trading science. They're based on this idea of support and resistance, which we know is in there. We know for all sorts of emotional, for historical and technical reasons, prices tend to find support around certain levels and they see resistance at certain other levels. The issue that I have with double tops and double bottoms, which has been shown in the analysis that I've done today, which I've demonstrated in this video, is that they are trend reversal patterns. And you've got to be using the right patterns in the right markets and at the right time. Through all of these 6 markets that I've analyzed, 6 of the most popularly traded ETFs, all of them have tended to trend upwards throughout this time period. And we cannot forget that. That is a crucial part of this analysis. And what this is telling me is the double top has failed much more often than the double bottom has been successful. And the importance of this is the double top failing is a continuation pattern, so that when we're in a strong trend, this trend is more likely to continue than it is to reverse. And this is a thing we all want to know when the trend is going to reverse. We all want to be early on a trend. It's great to be early on a trend, but it is easier. Look at this analysis. It is easier to spot when a trend is going to continue. And these have been the most successful trades over all of these 6 widely traded markets over 20 plus years of analysis. Now, I hope you enjoyed this video. I hope the analysis made sense to you. I hope you found it useful and I hope it's going to be beneficial in your trading going forward. Now, if you like this video, please hit the like button. If you want more content like this, please subscribe to this channel. And for more information about trading the financial markets, about backtesting your trading strategies, please go to tradeinformed.com.